Hi, it's Dan Soden and welcome to this month's edition of The Gavel, where we talk all things property and of course, auctions. So changes in interest rates, they continue to be the talking point, and within the property market, many are wondering what this impact may look like. Now, a recent report by Morgan Stanley suggested that the Australian banks have around $550 billion worth of loans as fixed rate loans, and they've been placed since 2019, and up to $400 billion worth of these loans will actually mature and become variable rate loans at the end of 23. So to unpack what this potentially means to mortgage holders, I've invited Wayne Pope from the Loan Market Breeze team in to give us some insights into what these rate changes will look like. So Wayne, I guess the first question is, in looking at these change in rates between the fixed term and now the variable, what is the likely change going to be?
Yeah, thanks Dan for inviting me on today, because this is a really important subject to get out there. Fixed rates since 2019 would have been somewhere between 1.79 and 2.8%. Today's lower variable rates, which are currently cheaper than today's fixed rates, are somewhere between 4.29 and 5.3%.
So in real terms, what's that? That's a change of almost 3% really. And what's that real change likely to be?
So on a $500,000 loan, this would be a repayment increase of somewhere between $675 and $980 per month.
Well, it's going to mean there's some real impact, isn't there? Some real impact when it comes to a cash flow of a household. What options do borrowers have if they're perhaps part of the fixed rate group and they're likely to mature sometime in the next 12 months?
Well, the first thing I would strongly advise is to find out early what the impact could be for you. Find out how much your repayments could be changing, so you can get prepared and understand how that's going to affect you and your budget. Then there are options that can be discussed to manage this. One thing though is to make sure that going forward you find that cheaper overall product for you when your fixed rate does expire.
Okay, and with interest rates continuing to be on the move, one of the things that I've noticed, at least in the transactional part of the business, is that buyers who have had pre-approvals in place and then have had to, those pre-approvals have lapsed and they've gone back to achieve a new pre-approval with a lender, they've actually had a revision to their borrowing capacity based on the change in interest rates. Can you talk to us about how borrowers are finding their capacities are changing based on rates?
Yeah, this is a great point, Dan. As interest rates rise, borrowing capacities are dropping. However, there can be a significant difference between how much each lender will loan you. So sometimes you might not need to put in a lower offer or potentially lose that property you got your heart set on. You might just need a different lender.
Okay, so it's fair to say that different lenders, depending on the criteria of the borrower, would be able to provide different capacities?
Absolutely, yes.
Okay, so it's certainly worthwhile checking out your finance position. If you want to know any more information around the finance side, just click on the links below and we'll make sure that Wayne's team is in touch with you. Now, best of luck, and we look forward to maybe seeing you at one of the weekend's open homes or indeed auctions. Until next time.